Welcome to our revision lecture on IAS 38. Now guys, again, this is a very theoretical standard, therefore please bear with me. I will read some of these paragraphs with you and some of them I will explain to you. First thing, you need to ensure that you understand what is an intangible asset. This is a non-monetary asset without physical substance. Therefore, you will not be able to always see it or touch it. The definition in terms of IAS 38 indicates to us that this is an identifiable asset and the entity should have control over the asset and be able to receive future economic benefits. Now, when we look at identifiable, an asset is identifiable when it is separable. Therefore, this means that we should be able to sell that asset separately to another entity. Now, even if we do not intend to sell it, it should be capable of being sold. Or it can be identifiable in terms of a contract or a legal right associated to it. Then the second important thing, the entity should have control over this asset. Now remember, we measure control in terms of our future economic benefits. Who will receive the future economic benefits? And number 3, our entity should receive future economic benefits by means of revenue, interest, dividends, and so forth. And then, as always, you need to comply with the recognition criteria. Now, guys, I'm going to include that I want you to please ensure that you read through paragraph 20 to 22 of IAS 38 in terms of our recognition criteria. Remember, it has to be probable and reliably measured. Now, next step. How do we recognize an intangible asset on initial recognition? How and when? Now, the standard indicates to us that an intangible asset can be acquired based on the following 5 different scenarios. Number 1, either purchase it separately, therefore a separate acquisition. Number 2, acquisition as part of a business combination. Number 3, acquisition as part of a government grant. 4, exchange of assets. And 5, internally generated asset. Now guys, when you look at this, I'm going to be honest. Number 1 is important and number 5 extremely important. Okay? Number 2, yes, when we look at our groups. Number 3, IAS 20 government grants, not that much important anymore. And number 5, exactly the same principles as per our PPE. Now, let's have a look at our separate acquisition. When an asset is purchased separately, we need to recognize that asset at cost. The cost will include the purchase price, which will be import duties, non-refundable purchase taxes after deducting trade discounts and rebates, and any directly attributable costs of preparing the asset for its intended use. When will we stop to recognize these costs? When the asset is in the condition necessary for it to be capable of operating as per the intended use of management. Very important, guys, remember, if there's any deferred payments, we need to recognize the asset at cost and you need to calculate the present value of these deferred payments. Number 2, acquisition as part of a business combination, guys, at fair value. You will remember when you refer back to our IFRS 3 principles that when the parent purchased the shares, the consideration paid to the previous shareholders should be at fair value, and all identifiable assets and liabilities should be at fair value. Number 3, acquisition of government grants. Now guys, at fair value, or we recognize the asset initially at a nominal plus any expenditure that is directly attributable to preparing for use. Exchange of assets, you can read through this on your own, exactly the same as per our PPE principles. I want to look at our internally generated asset. Now, you need to identify from the information provided in the question, when do we recognize our research costs and when our development costs? Now, all research expenses should be recognized in our profit and loss as an expense. Once they commence with development, and they can indicate to us that they will be able to meet all 6 of these criteria, we may know that we can capitalize these costs. Therefore, there has to be technical feasibility. For example, if an entity wants to develop a website, they need to source in a company that has the technical knowledge on how to do that. 2, intention to complete. Therefore, you will have to read. They will provide you with the dates when the project should be completed. Ability to use or sell the project. How the intangible asset will generate future economic benefits. The ability of adequate resources. Do they have sufficient resources to complete this project? And it should be measured reliably. The sum of all of the expenditures and directly related costs can then be capitalized as an intangible asset. In a theory question, when you need to discuss internally generated assets, please remember that you will have to start with a basic definition of an intangible asset, meaning that it has to be identifiable, under control of the entity, future economic benefits should flow to the entity, recognition criteria, probable and reliably measured. And then you are able to move on to the fact that you need to be able to identify the research section and the development section. And only once you are able to indicate that you comply with all 6 of these criteria, you may capitalize the costs. Now, let's move on, guys. Subsequent measurement. Now, when we look at our subsequent measurement, you can recognize the asset either at cost or in terms of our revaluation model. Now, remember, revaluation will not be tested, but I'm pretty sure that you can remember this based on your third-year knowledge. I want to move to our useful life. Now, an intangible asset can either have a finite useful life or an indefinite useful life. Now, when we look at our finite useful life, you need to remember that you will have to amortize the asset over its useful life when it is available for use as intended by management. And remember that amortization should be recognized in your profit and loss as an expense. Then you need to remember you will cease with your amortization at the earlier of derecognition, or if that asset is classified as an IFRS 5 asset, non-current assets held for sale. And important, your residual value will be assumed to be 0. Guys, unless they indicate to you that there is a residual value. Therefore, please read. And you need to review the residual value amortization useful life period at the end of each financial year end. Our indefinite useful life, no amortization. Now guys, This is an asset that there is no foreseeable limit to the period that the cash will be generated. And you will have to test for impairment annually and when there is an indication and review at each financial year end. Now, contracts. When a contract, for example, indicates that the useful life is for a period of 5 years, but the information in the question indicates that the useful life is 3 years, do you use the contract or the 3 years? You will have to use the contract's useful life. When the contract indicates to us that the asset agreement can be renewed for an additional 5 years, you may only use this additional 5 years, guys, if there's evidence that this is going to happen. Our next step, when to de-recognize an intangible asset. Either when that asset is disposed of or when we can identify that there will not be any future economic benefits from that asset. Then you need to de-recognize the asset and take it out. Then important, guys, I want to just quickly talk about our disclosure of intangible assets. Very similar to your PPE note. But what you need to please remember, and I'm talking from experience on this one, guys, when there is an internally generated asset, you need to include a separate column. This is a separate type of asset. Therefore, please remember to include a separate column and then another column for your other assets, such as your purchased separate acquisition of intangible assets. Then SEC 32. This will be, for example, when an entity spends resources, money in developing their own website, either for internal or external use. Do you capitalize these costs? SEC 32 indicates to us that we can debate and indicate that this will be an internally generated asset. Therefore, we have to prove that it has to meet our criteria. If yes, you can capitalize these costs. And then you need to follow the rules of IAS 38.